So picture the stereotypical uh, billionaire hedge fund manager navigating today's hyper-caffeinated stock market. You probably imagine like a room glowing with dozens of screens.
Oh, absolutely. The whole Wall Street movie vibe.
Right. Algorithms firing off trades by the millisecond, constantly moving capital around to catch the latest AI trend or, momentum swing.
Yeah, because the prevailing logic today is that to win, you just have to be moving.
Exactly. If your money isn't working 24/7, you're falling behind. But okay, let's unpack this. Because then you get your hands on the Q1 2026 playbook of the Bopos Group.
Right.
And this is the fund run by Seth Klarman, who is, one of the most legendary value investors alive.
hmm
And looking at this data, it completely shatters that high-speed stereotype.
It really does. It's a massive psychological trap. The modern financial ecosystem is basically designed to make you feel anxious if you aren't actively doing something. It equates activity with intelligence.
Yeah, but Klarman's strategy feels more like a guy sitting in a reinforced bunker just waiting for the absolute perfect pitch.
Yeah, while occasionally taking a stroll to the market's dumpster to dig out things everyone else threw away in a panic.
Exactly. So for this deep dive, we've got this massive, exhaustive 13F analysis report in front of us. It details Baupost's 22 equity holdings, which total about $5.12 billion.
Right. Their public U.S. equity portfolio.
Yeah. And the mission today is to look at the market through Klarman's eyes. We want to figure out what makes a business truly durable, how you find a real margin of safety when everything feels completely overpriced, and, well, why Baupost suddenly orchestrated a massive shakeup in their portfolio.
It's a masterclass in psychological discipline, honestly. But to really get into Klarman's mind, you have to start with his foundation.
Which goes all the way back to Benjamin Graham and David Dodd.
Yeah.
Right?
You have to start there. For Baupost, the primary objective of investing is not to beat the S&P 500 this quarter. I mean, it's not about relative performance at all.
Right.
The single guiding light is the absolute protection of capital. Like, do not lose the money.
Which brings us to that famous phrase, the margin of safety. It sounds like a bumper sticker, but it's actually a really strict mathematical discipline, isn't it?
Oh, it is. Think about building a bridge. If you know the maximum weight that bridge will ever need to hold is 10,000 pounds, you don't engineer it to hold exactly 10,000 pounds.
You'd want some wiggle room.
Exactly. You engineer it to hold 30,000 pounds. That extra 20,000 is your margin of safety.
Okay, so how does that translate to the stock market?
In investing, it dictates that you only buy a company when its current price is so dramatically below its actual intrinsic value that you are protected against, well, human error, bad luck, or extreme economic volatility.
You're basically building a financial shock absorber into the math.
Right. And because they demand that massive shock absorber, Baupost rarely buys the popular stuff. They are forced to shop in the distressed bin.
Like companies tangled in complex litigation or coming out of bankruptcy.
Yeah. Places where other investors just refuse to go because the headlines look terrifying.
I'm glad you brought up that strict discipline because it leads right into the most, mind-bending surprise I found in this entire report.
The cash position.
Yes. We mentioned the 13F portfolio, the publicly traded U.S. stocks, is about $5.12 billion. But Bellpost's total regulatory assets under management are actually around $24.68 billion.
The math on that is staggering when you really stop and look at it.
Right. It means nearly 80% of their assets are not even in the public U.S. stock market.
Yeah, they're sitting in private debt, European real estate, and a massive, massive mountain of cash.
Okay, but I have to push back on this. Wait, holding 80% outside of standard U.S. stocks, isn't cash just a drag on performance when inflation is a factor?
I mean, that's what everyone says, yeah.
It feels like sitting on the sidelines. We've had real inflation. Cash actively loses purchasing power.
It's a really common critique, but if we connect this to the bigger picture, we have to look at how Klarman views cash. He doesn't view it as a dead asset losing to inflation.
How does he view it then?
He views cash as a strategic asset class in its own right. It is pure dry powder. In the Baupost framework, cash is the ultimate provider of liquidity and optionality.
Okay, so waiting for a crash, basically.
Right. When the market panics, think back to the 2008 financial crisis, or the rapid rate shock in 2022 forced selling creates genuine once-in-a-decade bargains.
Oh, because everyone else is liquidating.
Exactly. Most mutual funds and retail investors can't act on those bargains because they are fully invested. They are going down with the ship, getting hit with margin calls.
So Baupost just absorbs the short-term drag of inflation during the quiet years.
Yeah, so that they have the firepower to be the sole buyer in the room when blood is in the streets. They're focused on absolute returns, not benchmarking.
They are essentially an insurance company waiting for a hurricane, and the cash is the payout fund. That makes sense.
Completely. They aren't trying to beat an index every Tuesday. They're trying to compound money over 3 decades without a single catastrophic wipeout.
Which makes their activity in Q1 2026 incredibly revealing. Building on that idea of protecting capital, Bellpost executed a massive shakeup. They had a nearly 43% turnover rate in a single quarter.
That is extremely high for them.
Yeah. They completely liquidated 6 positions, and the names they dropped tell a very specific story.
Right, they completely exited the payments processing and merchant sector, specifically Fidelity National Information Services, FIS, and Failserve.
And they also entirely dumped retail and construction materials, selling out of Dollar General and CRH PLC completely.
Yep. But while they were dumping those legacy processors, they initiated 6 brand new positions, pivoting really hard toward defensive brokerages and high moat networks.
The biggest move was Aon PLC,
Yeah,
right?
yeah, it was the largest new entry. They bought 769,000 shares, making it almost a 5% portfolio weight immediately. And they also initiated Visa.
So what does this all mean? To me, dumping traditional back-end processors like FIS and Fiserv, but backing up the truck for Visa and Aon, points to a clear anxiety about competitive pricing pressures in fintech.
Oh, absolutely. The barriers to entry for basic payment processing have just collapsed.
Right. It looks like he favors companies where customers literally cannot leave.
I think your read on the fintech anxiety is spot on, and Aon is the perfect example of this. Aon is a global insurance and risk management broker.
Okay, so what's their moat?
Their economic moat isn't a physical factory, it's institutional friction. It is built entirely on switching costs.
Meaning it's just too annoying to leave them.
Exactly. If you are a Fortune 500 corporation, your risk management architecture, your human capital data, your entire liability framework is deeply embedded with Aon's consulting teams.
You do not wake up one morning and switch brokers to save a fraction of a percent on fees.
No way. The operational risk of moving is just way too high.
Plus, the insurance brokerage industry is remarkably resilient to recessions. Like, if you run a business, you are legally mandated or contractually compelled to maintain insurance, whether the economy is booming or crashing.
Right, it's a completely non-discretionary expense. But let's look at the financial engineering, because that's where the value play really comes in.
Right, because Aon does not have a squeaky clean balance sheet. The report flags that following Aon's acquisition of a company called NFP, they're sitting on a net debt-to-EBITDA ratio of 9.8x.
Which is high.
Very high. For anyone listening who isn't a credit analyst, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's basically a rough proxy for the raw cash a business generates from its core operations.
Right, before the accountants get involved.
Exactly. So a ratio of 9.8 times means their debt is almost 10 times larger than their annual raw cash flow. In a world of high interest rates, a 9.8x ratio usually makes value investors run for the hills.
It sounds terrifying on paper, yeah. And that high leverage is precisely why the broader market dumped the stock, which created a depressed price.
But Klarman sees it differently.
Right. Klarman looks past the headline debt number and focuses on the velocity of the cash. Aon generates 20% net margins and produces $3 billion in annual operating cash flow.
Wow, $3 billion.
Yeah. When you have a money hose that powerful and the revenue is sticky because of those high switching costs we just talked about, you can pay down that debt incredibly fast.
So Klarman is taking advantage of the market's temporary panic over a balance sheet issue.
Exactly, because he knows the underlying business model is fundamentally a cash printing monopoly.
I get the defensive brokerage play. It fits the classic value mold. But here is where I struggle with this report. If Klarman is a traditional value investor, why is he loading up on massive tech companies?
It seems like a total contradiction at first glance.
The top 10 holdings make up nearly 74% of their equity, and it is incredibly top-heavy with big tech. Look at Amazon. It is now Bellpost's largest equity holding. They increased their stake by 47% just in Q1.
Right. For a guy obsessed with a margin of safety, loading up on Amazon is quite a statement.
And the numbers here are wild. Amazon's return on invested capital, which just measures how efficiently a company turns capital into profit, recovered from a miserable 3.8% in 2022 to nearly 13% in early 2026.
A huge turnaround.
But they're also planning to spend $200 billion in capital expenditures in 2026, mostly on AI infrastructure. So how does a value investor justify buying a company spending that much on servers?
You justify it by looking at what that $200 billion actually builds. Let's talk about DCF, or discounted cash flow models.
Okay, the bedrock valuation tool for value investors.
Exactly. It's a mathematical way of estimating the value of an investment today based on how much cash you believe it will generate in the future. The models in the report estimate Amazon's true fair value is around $395 a share.
Oh, wow.
Yeah, this implies that when Baupost was buying aggressively in Q1, the stock was trading roughly 33% below its intrinsic value.
So even factoring in the massive spending, the future cash guys are so large it's still cheap.
Precisely.
Yeah.
Because that massive capital expenditure isn't a waste. It is constructing an impenetrable fortress. You have the network effects of Prime and AWS.
Right. And Alphabet is the exact same story. They're spending $185 billion in AI capex for 2026. That sounds like a terrifying gamble until you realize they are funding it safely with $165 billion in operating cash flow from the previous year.
Right, they aren't borrowing to build the future. They're just paying cash from their search monopoly.
And then there's Visa, which is a new 4.14% position, the ultimate two-sided network effect. They need almost zero capital expenditure to grow.
What's fascinating here is that these companies represent a modern shift in value investing.
Yeah, usually we think of value investing as buying boring, old-school factories. But isn't a cloud network or a Visa card basically just a modern digital toll bridge? You literally can't do business without crossing them.
That is the perfect analogy. The margin of safety for these digital toll bridges isn't just a low PE ratio. It's the sheer unbreachable width of their economic moats.
Right.
The cost for a startup to build a rival global payment network from scratch or a rival cloud infrastructure network is astronomically high. Their value is in their structural dominance.
Okay, so we have these pristine digital toll bridges on one side of the portfolio. But to balance these massive tech bets, the portfolio utilizes what the report calls a barbell strategy.
Right, loading up on hyper-physical inflation hedging infrastructure on the other side.
The prime example here is Restaurant Brands International, ticker QSR, the parent company of Burger King and Tim Hortons. It's their second largest holding.
And running a fast food joint sounds terrible during inflation, right? Beef prices go up, wages go up.
Exactly, margins get squeezed. But QSR's moat is its franchise model. Explain how that protects Klarman's capital.
The franchise model delegates the inflation risk. QSR doesn't operate the vast majority of its restaurants. Independent franchisees do. QSR simply owns the IP and collects a top-line royalty fee.
Usually around 4 to 5% of total sales.
Right. Yeah. So if inflation hits and the price of a Whopper goes from $5 to $7, QSR's royalty cut actually increases. Meanwhile, the independent franchisee is the one who has to stress over the rising costs.
That is incredibly slick. It allows them to consistently hit a 9 to 10% return on invested capital and pay a 3.4% dividend.
Completely insulated from the grit of the kitchen.
Here's where it gets really interesting, though. You move from fast food to heavy logistics with Union Pacific. To me, this is the quintessential toll bridge business of the physical world.
Oh, absolutely. They operate a geographic duopoly with BNSF.
Think about what it would take to compete with them. Building a new transcontinental railroad today is literally impossible. The environmental reviews alone would take a decade. The ultimate moat is physical reality.
It is a true geographic monopoly. And moving freight by rail is 3 to 4 times more fuel efficient than trucking. Plus, they use precision scheduled railroading.
Which brought their operating ratio down to an incredibly lean 59.9%.
Right, and don't forget the macro tailwinds. Union Pacific is the only major railroad serving all 6 major Mexico gateways.
Oh, right, because of nearshoring.
Exactly. Companies are bringing manufacturing back to North America, and Union Pacific is structurally perfectly positioned for it. You cannot outsource physical logistics to the cloud.
They also added Wesco and Ferguson. Right. Wesco doing $23.5 billion in sales for grid and AI data center supply chains. And Ferguson has an 18.17% ROIC in plumbing logistics.
Yeah, and Americold and Eagle Materials. Americold relies on the high complexity barrier of cold storage, and Eagle is a geographic monopoly in heavy cement.
So we have the digital moats on one side and the physical moats on the other, but we haven't touched on the final piece of the Baupost puzzle. Section 5 of the report, the trash ban.
Ah, yes. Distressed assets.
Buying what others actively hate or fear, like Elevance Health and Molina. Elevance is going through a 2026 trough year because of Medicaid redeterminations.
Right. Their earnings are temporarily depressed because of healthcare regulation fears.
Wall Street panics, but Klarman looks at the free cash flow yield. Elevance is generating an 8.7% free cash flow yield right now, so he steps in. But I have a question on one of these other holdings.
Sure, which one?
Herbalife. Holding Herbalife next to Alphabet seems wild. I mean, how does a purely objective value investor justify holding a highly controversial MLM company?
This raises an important question about the absolute return mindset. Klarman looks purely at the cash flow generation and customer loyalty.
He just ignores the PR nightmare.
Completely. He strips away the market's emotional sentiment. Does this business generate predictable free cash flow? Yes. Is the stock price beaten down so low by negative sentiment that it provides a massive margin of safety? Yes.
Just ruthless objectivity. Emotion and headlines simply do not factor into the spreadsheet.
Exactly. They also bought Grupo Aeromexico post-bankruptcy, UDS Holdings despite Chinese regulatory fears, and Liberty Global for European last-mile fiber. It's all about cash flow and niche moats.
Like Teleflex with clinical switching costs for surgeons, Vaxcyte with its pneumonia vaccine IP, and Norwegian Cruise Line with vessels that cost billions to build.
And genuine parts, or NEPA with logistics for aging cars, it's all distressed value.
So pulling all of this together, the Q1 2026 barbell strategy is clear. Wide moat tech on one side, unreplicable physical infrastructure on the other.
And a willingness to buy the market's discarded trash if the math demands it.
Exactly. When evaluating your own investments or even your career skills, you have to ask yourself, what is my moat? What is my margin of safety? Before we wrap up, a special note for those of you looking to apply these concepts. To access more advanced researches, applications, and our latest published Personal Intelligent Multi-Agent Deep Value Intelligence, welcome to explore and join the deepvalues.ai community. And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
We also want to remind you of our standard disclaimer. All analysis today is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
Exactly. If you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
And I want to leave you with one final provocative thought to ponder. If one of the most successful value investors in history is currently holding 80% of his firm's assets outside of the public stock market, what does that tell you about the true value of the public markets today? Are we all looking for bargains in the wrong place?
Waiting in the bunker for the perfect pitch. Keep evaluating your moats, and we'll see you on the next deep dive.